Have you heard of Bitcoin, Ethereum, or Polkadot? Are you invested in cryptocurrencies? If so, how much exposure do you have in your current portfolio? Hi, I'm Colin, Assistant Manager of Macro Research from iFAST Research and Portfolio Management Team. Today I'll be sharing with you guys our views on cryptocurrencies and more importantly, why we would like to sound a cautionary bell against investing in them. So on the screen, you can see the performance of major cryptocurrency coins in the year to date. The asset class as a whole has been through a challenging and volatile quarter, which saw drawdowns anywhere between 30 to 60%. In fact, the drawdown has been rather broad-based, as we can see it across many of the coins, from the highly popular ones such as Bitcoin and Ethereum to other coins such as Polkadot and Uniswap. This massive drawdown also triggered a surge in volatility in cryptocurrencies around the same period in early May. I would like to highlight the cryptocurrencies volatility, especially when compared to traditional asset classes such as your equities, bonds, commodities, and even currencies. As highlighted on the screen, this chart compares the annualized volatility both on a 1-year and 3-year basis across major asset classes. You can clearly see that the annualized volatility for cryptocurrencies, in particular Ethereum and Bitcoin, vastly surpasses other asset classes. We are looking at a 3-year annualized volatility of between 80 to over 100% for Ethereum and Bitcoin, compared to around 50% for oil, which is one of the more volatile traditional assets. With that said, here are 6 reasons why you should not invest in cryptocurrencies. Cryptocurrencies' lack of backing by a central authority is a big reason why there is no intrinsic value for the asset class. Based on traditional definition, because of this lack of backing by central authority, cryptocurrencies does not serve as an official medium of exchange or as a unit of measurement. This is in deep contrast with fiat currencies, which are heavily defended by their respective governments. So let me share an example. In times of uncertainty and market volatility, a country's domestic currency may fluctuate and central bank may regularly intervene to stabilize them. Essentially, they tend to buy or sell their national currencies in their country's spot foreign exchange or through other financial assets such as forwards and bonds in a bid to stabilize their domestic currencies. It is this support and backing by their central government that adds stability to these fiat currencies, which ultimately enables them to be used as an official medium of exchange, thereby giving them intrinsic value. A major fundamental shortcoming for cryptocurrencies is the absence of fundamental and intrinsic value, unlike conventional asset classes. In the traditional sense, intrinsic value would refer to the true worth of an asset, which takes into account fundamental factors and future expectations of the asset. Using the example of a company, its intrinsic value or fair value would therefore be the value of future cash flow discounted to the present day. This certainly would not be applicable for cryptocurrencies, as one of the biggest drawbacks would be its inability to generate any form of cash flow or income. Unlike equities, crypto do not generate earnings like how a company normally would. Additionally, cryptocurrencies does not offer coupon payments like a fixed income instrument. Some may argue for cryptocurrencies various forms of yield farming, but those are also not contractual obligations like the ones provided by a conventional bond. And in sum, the lack of earnings or coupon payment makes it impossible to formulate a credible and reliable valuation framework to derive an intrinsic value. To extend our view further, we also see no credible way to derive a proxy value for cryptocurrencies, as it is impossible to map the asset class to any physical asset. This stems from its lack of real-life utility, as the asset class is not substitutable as an input for a commercial product. Take for example, it is infeasible for any coins to be used as an input, unlike commodities such as copper or silver, for the production of a priced physical asset. They may otherwise offer a proxy value for such input. Aside from the lack of cash flow and income, cryptocurrencies do not have a proven long-term relationship with economic fundamentals, unlike equities, fixed income, commodities, and even currencies. So let me give you an example. Assume an economy is experiencing robust recovery. This tends to create stronger sales environment for companies through factors such as an improving domestic demand or accommodative policy such as a low interest rate. The stronger sales environment benefits companies as it uplifts earnings growth and may even generate positive earnings revision, which ultimately can drive equity prices. So essentially, when we break it down, we can see a clear economic rationale which supports higher asset prices. However, for cryptocurrencies, it is challenging to establish any reliable and clear economic rationale that underpins its price. We think that it is also too early to conclude that cryptocurrencies have such an economic relationship, as the asset class has yet to go through the various macro regimes. Furthermore, the speculative and volatile nature of the asset class further makes it harder to establish such relationship. And this ultimately leads us to conclude that even from an economic standpoint, there is a lack of fundamentals in cryptocurrencies. Given the absence of intrinsic value and fundamentals, we think there is no way to ascertain if cryptocurrencies are overpriced or not. As a result, investors are often unable to determine if they are buying in at a high or low. This is unlike traditional asset classes, which a target price can be derived or has a reliable valuation metrics to guide investment decision. And that said, we believe investors may end up unknowingly buying into a cryptocurrency bubble. With cryptocurrencies still being largely unregulated, we expect government intervention to be powerful obstacles that can potentially impede the development in the cryptocurrency space. This may come in many forms, but we think the threat of taxation policies, as well as regulatory frameworks established to protect retail investors, are very real to cryptocurrencies. China has taken a lead in terms of such government intervention. The Chinese government authorities have recently stepped up its efforts in the nationwide crackdown against cryptocurrencies. Lately, we saw the government clamping down on all cryptocurrency mining activities as strict orders were issued to halt cryptocurrencies mining in key hubs from the north as well as the southwest region. More recently, we also saw Beijing starting the crackdown on trading and exchanges as Huobi, operator of one of the world's largest cryptocurrency exchanges, halts derivative trading in China. Globally, many central banks are also planning to issue digital currencies of their own. If you Google central banks digital currency, you will see that many central banks are making plans to issue digital currencies of their own. Switzerland, Russia, and China are just some prominent examples here. Again, if we circle back to China, we think that the recent crackdown on crypto is also to prepare for the eventual rollout of its own digital currency, the digital yuan. While the People's Bank of China has not yet put a definite timeline to this initiative, we think the reality of a digital yuan is very real. In fact, China has took its first step in rolling out the digital yuan. Just recently, public transport operators in 3 major cities are now accepting the digital yuan as payments. Many ATMs in Beijing have also started to offer digital yuan withdrawal, making it acceptable and accessible to the public. This example set by China therefore puts into perspective that the competition between cryptocurrencies and the central bank's digital currency is in fact very real. And in a broader sense, the rollout of a nation's own digital currency may in fact serve as headwinds for crypto by either displacing it or prompting tighter regulation. We think certain cryptocurrencies have the hallmark of a cornered instrument. Let's use Bitcoin as an example. If you look at Bitcoin, the holdings are fairly concentrated as compared to traditional asset classes. It is estimated that almost 30% of Bitcoin is held by a few large whales. These are people that hold a lot of Bitcoin. And on the contrary, smaller owners account for around 14% of the Bitcoin supply and exchanges, while custodians and miners account for around 11% of the Bitcoin supply. With such concentrated holdings in Bitcoin, these whales have the ability to influence the market, which can leave the general investors vulnerable. What happened a couple of quarters ago was a prime example. According to blockchain data, the number of whales has risen in tandem with Bitcoin prices from late last year to February this year. So this strongly implies that there is a significant influence that they have on the Bitcoin market. Fast forward to the last few months, we saw the reverse. The number of whales has fallen and Bitcoin prices are declining in lockstep. Another thing to note here is that given such concentrated holdings, it is that the supply shock will be one of the key risks in Bitcoin. This remains a likely situation moving forward in the event that these whales liquidate large chunks of the holdings all at once. We think cryptocurrencies are arguably still in their nascent stage of development. There is a long way to go at this stage for cryptocurrencies before a possible wider adoption. We see two main hurdles here which adds much uncertainties to when cryptocurrencies will make it out of this stage. These hurdles, as I've highlighted earlier, are number one, government intervention, which is motivated by financial stability and limiting speculation. And number two, which is closely linked to number one, the possibility of being displaced by national or central bank currencies. Taking a step back, even if we were to assume that cryptocurrencies successfully evolve into a more permanent fixture of our modern monetary system in the near future, there is a limited promise that any of the current coins will survive past their infancy. The lack of fundamentals and intrinsic value of crypto, like what I've highlighted earlier, meant that there is no reliable way to project the future growth of not just individual crypto coin, but also that of the broader market. We are cautious of extrapolating the total market cap growth of crypto as an asset class to date, as we think that such parabolic rate of growth might be unsustainable in our view. Overall, this makes it hard to establish a reliable long-term investment view on crypto, which we believe is important for a long-term investment. As I've highlighted earlier, cryptocurrency boasts one of the highest volatility amongst the asset class. Therefore, from a portfolio management perspective, we expect the addition of cryptocurrencies to a portfolio to push up the overall volatility. This may run against the objective of investors who are more risk-averse or those that intend to keep their overall volatility low. The other key point which we believe is that crypto's extreme volatility renders it challenging for long-term financial planning and very unreliable as a store of value. Investing in crypto requires even more emotional discipline as compared to traditional asset classes. In the near term, this may not be too much of a challenge for investors, but we believe this may weigh on investors in the longer term, making financial planning even more challenging. Most cryptocurrencies are highly momentum-driven, with momentum strategies dominating directional movements in the asset class. While prices of crypto can ride on momentum higher, the reverse is also true. If the momentum signal for crypto reverses, it has the potential to trigger a crash in momentum, as these strategies act on the strength of momentum irrespective of the price direction. This means heavy selling can trigger even more selling. The result of this will be a sharp drawdown like the ones we saw in recent months. That said, we see fading momentum as one of cryptocurrencies' key price risks. The other pitfall for us is that cryptocurrencies are vulnerable to a high leverage buildup. Many crypto exchanges offer investors a dramatic amount of leverage, anywhere between 3 to 5 times to above 100 times. Compared to traditional asset classes, there is definitely a higher risk of a leverage bet imploding, and when it does, investors may be left vulnerable to sharp and violent drawdowns. We liken investing in cryptocurrencies to the greater fool theory. So any investors who subscribes to this theory disregards fundamentals and knowingly buys into overvalued assets. Because everyone assumes that there will be a greater fool out there who will take the hot potato off their hands and netting investors an easy profit, or so they think. It is all fun and games until you ended up as the final fool, and at that point, there is far too much risk to undertake for far too little reward. This is exactly what we have been seeing in the crypto space right now. Many investors are buying into cryptocurrencies, fully aware that the value that they are paying for is nothing near what they have paid. Despite that, many still willingly place big stakes in hopes that a greater fool comes along, as emotions and irrationality often get the best of us. With that said, we would like to sound the cautionary bell against investing in crypto. And before I end off, we would like to remind investors that investing is not a game.